We'll go ahead and get started. So my name is Christian Foster, and I am a senior wealth advisor with Diversified here in our Birmingham office. As many of you know, their clients, or maybe first-time guests don't know, we have offices in 8 different offices in 7 different states. So we are in the Birmingham office, and it's my pleasure today to introduce somebody that I get to work with closely, which is a major benefit. Mike Horwath. This is our Chief Investment Officer. I think joined Diversified in 2016, doing a great job, and then started leading our investment team and investment council in the firm in 2019. Has a lot of experience with this and does a great job. So today, Mike's going to talk a little bit about positioning, opportunities and risks that he sees in the market, his take on it, how he leads our investment team, and the changes that we make, things that we look out for. So we'll also have some Q&A. If you see the Q&A down at the bottom of the Zoom, if you ask a question there, hopefully this should last about 45 minutes, give or take. We'll have some time to get to some questions, and we'll go from there.
Beautiful. Thanks, Christian. Welcome, everybody. Thanks for joining. As always, this is our quarterly investment update. As always, we try to have about 25-30 minutes of prepared remarks around what's going on in the economy, what's going on in markets, how we're thinking about everything, how we're positioning, what's working, what's not, all that stuff. Kind of a shameless plug. We have our newsletter coming up here. It'll go out this afternoon. That newsletter is similar to what I will be presenting today. It's a little bit longer format, written. I have plenty of Halloween-themed puns, so get excited. I can assure you, you will be sick of them by the end of it, but that will be going out this afternoon. And then just so anybody who is local to the Delaware or Pennsylvania offices next month, November 13th, it's a Thursday, 6 p.m., we will be doing our annual Market Insight event at the DuPont Country Club. So look out for that invite. But we'll be joined by someone from JP Morgan, and we'll do a little fireside chat and do a similar kind of format that we've done in the past. But with that said, why don't we just jump right on in? The theme of this quarter update is once again a horrible Halloween pun. It is a Nightmare on Wall Street. It'll make sense as we kind of go through it. But at the end of the day, right, what's not spooky? Once again, loving that theme, the market. And I think this is one of those big things that has come up a lot, which is I think a lot of investors are in this weird dichotomy of a lot of things on the equity side are working, right? You'll see on the right-hand side, the amount of all-time highs measured by those bar charts on each calendar year. The last 2 years, we've hit several new all-time highs in the S&P 500, right? Which measures US large cap stocks. Markets have rallied really strong, really coming out of 2022. It hasn't been a perfect line. If you go from point A to point B, it may feel like this perfect line, but at the end of the day, there have been several pullbacks along the way. But markets have really rallied, especially since the April 8th low that we saw earlier this year. If you go backwards from February 19th through April 8th, what we saw was this pullback on tariff fears, right? And a lot of uncertainty around what tariffs meant. You had this April 2nd day of really launching a lot of the tariff conversation. And since April 8th, when markets bottomed, the focus has gone from the uncertainty driven on the tariff conversation to a focus around fundamentals. All right, what we mean by that is what's growth, what earnings look like, what do profit margins look like, right? This whole AI theme has really dominated investment and market returns. So when we think about what's happened since April 8th, it's been this transition to focusing on earnings, right? The tariff conversation isn't gone. Well, we'll touch on that for sure. But the focus on equity returns has largely been this all-time high and really operating margins, corporate earnings that are not dropping in expectations. Their expectations are actually moving higher as we go into 2026. And you're seeing all of these conversations going on around the hyperscalers, right? We'll talk about that a little bit, which is, the Metas, the Googles, the Oracles, investing a ton of their free cash flow into building out artificial intelligence and the infrastructure there. But equity markets have really not been spooky since really April 8th, right? And there's a ton that we talk about, that we think about in terms of what could go wrong or what are the things that we have to keep an eye on. But just in terms of pure returns, equity markets have really been a great story, especially coming out of the third quarter here. International markets, the U.S. side, you'll see here in a second, has had a solid return this year. When you look at U.S. large cap, the S&P 500, international equities have actually outperformed the U.S. by almost double this year. So we'll touch on that, but that's been a really interesting theme this year. International markets driven by a couple different things, one of which is the weakening dollar, but it's also just this expansion of the multiples that were really cheap in international stocks to now have kind of started to catch up a little bit to U.S. equities. And then even on the bond side, right? We talked about equities not being all that spooky in terms of returns last quarter. Core bonds are up over 6% this year. So it's been a really good contributor to equity market returns. When you look at a diversified portfolio, these two things combined for a diversified portfolio have really helped drive returns. When you look at asset class by asset class, what we saw was the top line, the ACWI, the All Country World Index, up about 18% this year. Now, what's been the case the last really decade is if you looked at this at any given time, the S&P 500 and to some smaller extent the Russell 2000, U.S. large cap, U.S. small cap, have largely driven those returns. International stocks have actually probably been the bigger headwind. Well, you flip that on its head this year, where you see international developed stocks up about 25 through the end of the quarter, and emerging markets up 27. So nearly doubling the S&P 500. So all this talk about how strong the U.S. equity market has been this year, which is not incorrect, right? Which is a true statement. International stocks have been just as big and actually a bigger contributor to portfolio returns than U.S. equities. And on the bond side, like I just mentioned, U.S. aggregate bonds up about 6.1% through the end of the quarter. It's been a really nice contributor to see diversified returns on the bond side of the market, and diversified investors who used bonds to kind of toggle their risk have certainly benefited from owning individual fixed income within their portfolio. So sticking with our theme, let's play a little game of trick or treat. All right, so what I want to focus on are 4 key comments that we're hearing, or themes or questions, and is there something to it? Are there legs? We'll call that the treat. Or is it something we're a little bit concerned about, or something we're kind of putting under a microscope? And that's kind of, we'll call that the trick, right? And let's start with AI. So I think the AI conversation has a lot of, and I'm not stepping on a ledge here to kind of say this to a lot of people, but it has a lot of the 90s internet feel, right? This revolutionary technology, a ton of investment, a lot of equities seeing some rally, some of which are probably warranted, some of which are probably a little bit more concerning, which we'll talk about a little bit. But the comment we continue to see and hear, right? We go back a couple of years, as even Google had mentioned this going back a couple of years, but you see it from executive teams of these large companies over and over again. You're seeing Jamie Dimon in the news right now. The risks to underinvesting in AI are bigger than the risks to overinvesting. So that is going to be a theme you see throughout, and there's going to be ebbs and flows. I think you have to start to worry if there's an element of debt getting involved over the free cash flow, because some of the benefit that these hyperscalers, someone like a Meta or a Microsoft, Google, Oracle has been in the news quite a bit. A lot of these companies are able to produce the investment out of their cash flow. So Meta and Google, as examples, their ad revenue is so enormous and so profitable that they're just able to reinvest that cash flow into building this out. Now, is the return on that investment going to be worthwhile? Well, we'll see, right? But their concern is to underinvest in this space moving forward. So you can see on the right-hand side, the CapEx, right? The capital expenditures for a lot of these companies has been massive. We don't expect this to slow down. You're seeing it every single day between these big names with NVIDIA, with private companies like OpenAI or the other large language models. You're seeing this theme run rampant because it's all in the hopes of building out either additional profitability in the future or creating efficiencies to have more productivity or cut costs at some point in the future. Once again, the question comes down to long term is, who's going to be the winner, right? Who's going to develop the products and services? Who's going to see the return on that investment really come to fruition? But there's a lot of legs to this. I don't think you need to run from this. I think this is an exciting change to really all of technology. But I think when investing in it, I think there's a way to focus rather than just throwing everything at the wall, right? I think that's some of what's happening, right? Especially at the retail world right now. But when we look at AI, certainly a lot to like there. And it's certainly something that's pretty exciting moving forward. What I will say, right, and the question we'll get and we talk about is the economy and the market are not always the same thing, right? There's a lot of difference there. And just because the market's doing extremely well or doing really poorly, it doesn't mean that it translates perfectly to all economic data. So what do we mean by that? So if we look at the hard and soft data, so let's start with the hard data, right? These are the numbers that you would expect to come out. There's a lot of good, not great. What do we mean by that? GDP growth has been good, not great, right? It's not like we're coming out of a recession, you see this huge acceleration, but it's been good, it's been adequate. And you're seeing actually projections for this quarter growth rate to be upwards of 3.5%, 4%. That's a good number. You see consumer spending, it's been good, not great. And here's the nuance to a lot of that. I think the consumer spending aspect depends on where you fall in the income level. The challenge is the bottom 50% income earners don't feel and aren't spending to the level that the upper income individuals are. Now, the higher income, especially the top 10% of income earners, disproportionately drive aggregate consumer spending. So it's something we have to really focus on. But this is where you're going to start to see some difference and nuance in when you say good, not great for consumer spending. Inflation's been well behaved. Will that continue as we start to cut rates? Hopefully. But inflation's been good, not great. It's not down below a level where the Fed is comfortable, but the Fed's content with where it's at. Once again, a lot of good, not a ton that's great, but a lot of good. The soft data is where you start to see some of these nuances where the sentiment surveys, and there's a lot of nuance to these discussions and a lot more than just meets the eye in terms of what soft data means. But these sentiment surveys are a little bit all over the place. So you see on the right-hand side, consumer sentiment does ebb and flow over time, as you'd expect. At the bottom of the 2008, 2009 crisis, sentiment was awful. You look today, despite what equity markets look like, despite what largely the economy has been, sentiment's pretty mixed. And you look at outlook for inflation, spending, business conditions. It's once again, it's a mixed signal, which tells you that not everybody's feeling as good as some of the market and the economy in some areas are telling you. The good news, if we kind of take it a step further, though, is you're kind of going into this phase of accommodative fiscal and monetary policy. So when you have both the government spending, right, which is an issue in some ways, but accommodative fiscal spending, the big beautiful bill, right? There were a lot of pieces there where we saw CEOs that were quite happy with what came out of that. So a lot of businesses are quite content with some of the fiscal side of the conversation. And then monetarily, kind of leading into this, the Federal Reserve is going to become accommodative, right? And they've started this process. The conversation goes back to this economic condition, though, of the labor market, right? The risk in the labor market, which is one side of what the Fed's worried about. So if you think about the Fed's dual mandate, they're worried about labor markets, keeping unemployment low, and on the other side, keeping inflation anchored low, positive, call it 2%, right? That can ebb and flow, but anchored, low, reasonable. Well, the Fed is sitting here today, and they are clearly saying now that their concern is that the risks are skewed towards the labor market weakening, and we're ready to start cutting. So we saw the first rate cut of 2025 take place last month. The expectation is for another two, right? So in the next meeting coming up, and then in December as well in the last meeting of the year. So that would be 3 cuts in 2025. Now, there's some divide in how the Fed's approaching it, right? Some want to cut more aggressively. Some want to be more careful because the risks are naturally that inflation could tick up. We'll discuss that a little bit. Do we expect that to a extent that we saw coming out of, going into late 21 into 2022, where we saw, inflation rates, drive quite a bit up. No, but the risks are still there. And if they're cutting and they get inflation that becomes persistently high, that would be a jolt to that policy. But a cutting cycle should support growth. And then, we're obviously focused on the other side of the conversation, right? The inflation conversation, what could push that higher? And then how do we mitigate that potential risk if it were to come up? But the Fed in general, right? This is certainly a treat, right? They are now becoming more accommodative. We'll see what the ultimate effects are to the housing market. There has clearly been a lot of stagnation in the housing, and lower rates will help. Will it come down to a point, though, where that really actually helps improve the housing market? The tariff side. I think the conversation we get is, has the market, or have you guys completely forgotten or maybe don't care about the tariff conversation? And my sense would be, no, you need to have a keen eye on it, because it can impact two different sides of this conversation. You should still focus on what that policy will bring to fruition, because we're still not sure. There's still a lot of movement. There's still a lot of policies that haven't been really figured out in terms of country by country. There's still a lot of movement that can change day to day. But coming out of that April 8th, we talked about that bottom of, that quick fall from February 19th to April 8th, the tariff kind of induced pullback in equity markets. The turn has been to more of the fundamentals over tariffs. Well, we'll see what happens looking forward, but inflation's been well behaved. The two things we're focused on are the inflation conversation and the demand destruction conversation. So if you look on the right-hand side, the point of all this is, what were expectations going into the tariff conversation, right? Into the tariff policy, and what kind of happened? So expectations going into it. If you think about tariffs, there's three different ways that they can get paid, right? They can be borne by the foreign exporter. So the exporter can lower their price so that after the tariff, the US business that imports it pays the same price. The expectation was that a small amount would be absorbed by foreign exporters, and that's essentially what's happened. Then the other two sides of it are on our side, right? The business that's bringing it in can either absorb that cost and make less money, or they can increase their prices, maintain their margins, and then pass it to the consumer. The expectation has been, by most economists, that the consumer would bear most of that cost, call it 70-ish%. What we've seen, though, is that businesses have largely taken it in stride and absorbed most of it. Now, is that sustainable? Is that likely to continue? Right? If profit margins, which have been if you look at profit margins here in the US, operating margins have largely never been higher. Part of that's because the tech industry has such high margins. That's a big part of it. But will businesses continue to let those margins maybe constrict a little bit, or will they pass it on to the consumer? We do think that there will be, continued flow to the consumer, right? The consumer will bear it. And then the question becomes, and the question we have to kind of answer on our side and think about on our side is, once it does pass the consumer, as it does pass, is it going to increase inflation, right? Because it's just a one-time increase in cost. It's going to increase, inflation in the short term. Or is it going to destroy demand a little bit, right? Where people spend or buy fewer things, right? Instead of buying 10 units, they buy 9 because it's more expensive. Right, which obviously at that point can when you destroy demand, that's naturally a concern from a business and economic perspective. So both are things we're focused on. Up to this point, we've seen the US businesses be resilient to it, taking it in stride, but there's still a lot of pre-tariff inventory that had rolled off. I think there's still a lot to be figured out here. And that's something we're naturally focused on, is the tariff conversation shouldn't leave. And we'll talk about it here shortly, how we're thinking about within the context of our portfolios. But from our perspective, if you're thinking trick or treat, this is to us on the treat side, or the trick side of the conversation, where don't get lulled to sleep. It's still there. The good part is that other factors have helped drive and kind of overshadow this, but it's still something underneath the hood. So how are we thinking about portfolios? There's a couple different things that I would recommend, kind of focusing on when we talk about it. The main story that we've continued to lean into and that we're talking about is quality. When things happen and we have this kind of theme, it's kind of like coming out of a deep recession. We're not in that type of environment, but some of these market dynamics tend to be a little bit where you're seeing some unprofitable or even pre-revenue AI businesses, right, or tech businesses start to really have strong equity returns. And to us, that's just quite frankly not something we're going to chase. It's just to us not sustainable. So our focus is, look, we're going to lean a little heavier into US large cap, especially on the growth. The dividend growth, right? The quality side, right? Quality has been our main theme. Why quality, right? At a time when there's a little bit of uncertainty from a growth perspective, from a labor market perspective, there's a lot of uncertainty there. To us, it's not a time to lean into high risk, what we would call high beta type investments, right? Our focus is on staying higher quality, right? Businesses with better free cash flow, with big moats, companies that have high margins, consistent net income, right? Operating income. To us, that's where we want to play. We're not trying to be overly speculative. We're not trying to lean too heavily into this AI theme. We certainly have a sizable allocation just via the market and some of the other things we're doing. But quality to us at a time like this, higher on the capitalization spectrum, large cap, is a clear focus for us right now. And it's been that case for a little while. And like I said, we are not going to chase unprofitable businesses and take on extra risk to chase that theme. Just not what we're going to do. International is still about 15 to 20% of our recommendation typically. We're not overweight. We've gotten this question because international has rallied. I'd focus on the right-hand side. So the right-hand side focuses on each of the major asset classes, right? It's the world, US, then developed, and then emerging, right, on the right-hand side. The bars represent earnings expectations from a growth standpoint for the next 12 months. The conversation to us still relies on where are earnings going to be and where are they growing. And despite the US being more expensive, which we have to acknowledge, the US is more expensive than the rest of the world. To us, there's a reason why, and we prefer to continue to lean into it because the growth rates and the types of theme that we're seeing here in the US and the investment in the US, we just like and prefer that theme over international. Doesn't mean that there's not opportunity. It doesn't mean that we don't want to remain diversified. Because you look on the right-hand side, emerging markets have actually had a nice rally this year, and we've been benefited by owning it. But when we say we're overweight the US, this is still why we have that conversation and that opinion. On the fixed income side, we still prefer shorter duration, especially on the corporate bond side. If you look at bond spreads, the bond guys, we call them, right? The bond analysts, the bond portfolio managers, they tend to really lead markets. So when you start to see bonds start to sell off because their spreads widening, what that means is that they're requiring more compensation to take on the risk of owning the debt of Johnson & Johnson, just making up a company. They're usually pretty smart. They're usually leading the market. What we see today are corporate bond spreads really tight. That means there is a lot of confidence in the ability of these corporations to cover their debt, to pay their debt, the health of their revenue stream, the moats of their business. We like leaning into the corporate fixed income. You get a little bit more yield. You may not be compensated like you used to be, where things start to widen, you get a little bit more compensation over treasuries as an example. But to us, it's the preferable place to be. You avoid some of the concerns with US fiscal policy, and we do like leaning into corporate credit. The one thing we have looked at adding, and we have added in a lot of portfolios, are TIPS positions, right? We still like having some government fixed income within our fixed income allocation. The reason being is that when equity markets pull back, there are few things that hold up as well as government fixed income, right? Even corporate fixed income, even at the highest quality, can have some pullback because naturally the business conditions start to worsen and you start to worry about the ability to cover credit, even for the best credit quality within the corporate fixed income world. So we like owning some corporate or government fixed income just to help diversify that portfolio. What we're doing is we're changing a lot of it over from nominal treasuries to inflation protected treasuries. This isn't a bet that inflation is going to drive up, but we ask ourselves all the time, we say here today, what are the risks to the portfolio moving forward, and what do we want to maybe hedge a little bit against? You saw it in 2022. A lot of the concern comes in where we are within our bond portfolio exposed to, and all bonds really are, unless they are hedged for inflation, they're exposed to higher rates and usually higher rates and inflation moving higher. Why? Because most bonds are fixed rate. So if I own a bond that pays me 4%, if inflation's higher or rallies higher, that bond on a real basis, net of inflation, has lost a lot of value. Well, tips help us kind of hedge that a little bit. So we're just adding it into a lot of portfolios to ideally try to mitigate that risk in the bond side of the portfolio. It's not a, once again, it's not a call that inflation is going to go up, but it is a kind of a risk mitigation process that we're going through. We still want to keep an eye though on a couple main things. One, we ask ourselves, what could pull back markets? What could pull back the economy? One on the market side, we're not overly concerned about because we're not exposed in the same way. But when we start to see, I mentioned it earlier, unprofitable businesses that either are unprofitable or that are pre-revenue, right? Companies that, you think back to the late 90s, that a lot of things were being thrown at the wall. A lot of this on the retail side, we just don't like it. We expect it to either start to come back to earth at some point or the rest of the market to kind of catch up. But at the end of the day, we're not going to chase that. We do keep an eye on valuations. It's important to understand what you pay for something matters a ton. Now, as long as you're being compensated to pay up a little bit, right? You're being compensated via larger growth rates. That'd be an example. That's something we're focused on. And then lastly, this AI spending narrative, we just want to make sure it's going to continue, right? So one of the concerns we see is that what happens if and when a Meta or a Google says, look, maybe the ROI that we're spending into this AI space isn't there. We need to either dial it back. We need to become a little bit more fiscally prudent. Does that start to unravel some things given how much has been spent and priced into markets? We don't expect that, but it's something we naturally need to keep an eye on as we move forward. Just some of the portfolio highlights, things that I would give examples of things that have been working in diversified portfolios across the board. Emerging markets, right? Naturally, they've been a lag in a lot of portfolios. These are typically, the Latin American countries, India, parts of China, a lot of Hong Kong listed securities. A little bit of Taiwan with TSMC tends to fall in here. Well, the emerging market side is within international has done really well. And one of the positions, as an example, is up almost 28%, over 27 on the year through September. Just really adding value within the emerging market space. A lot of people know who've been with Diversified for a while. The semiconductor ETF is something we have just been leaning into that theme. And that continues to be a really strong performer, given the fact that, everything you expect, right? The NVIDIAs of the world, the AMDs, the Broadcoms, the TSMCs, ASMLs, a lot of these businesses have benefited from this AI theme, which initially started as more of like this Internet of Things, right? That was really our main theme early on, was just, everything in your pocket, the phone, your watch, all of a sudden, all these chips and the semis in these spaces, driverless and autonomous cars, even just electric vehicles. The technology needed for these has certainly grown, and we just expect that space to grow. Well, that continues to be a really good story. And then naturally, I mentioned it earlier, it's not a super fun thing to talk about, but core fixed income, right? The diversifiers of our portfolio have really done a pretty good job adding some value and adding some return above kind of low single digits. We've actually seen mid to high single digit returns in a lot of core fixed income strategies. So they're really good additions to portfolios this year. So there's a lot of things that are working, which is good, right? Diversified portfolios in general, there's always going to be something that works better than something else. That's just the nature of diversification. Something will always not work. But in general, there's been a lot of things that have been working pretty well within portfolios this year. So really just to kind of summarize things, one, I have a lot of good Halloween puns in my newsletter. Give it a read. But two, when we kind of dig into what's going on in markets, naturally, markets have rallied strong. I don't want that to be scary or to be overconfident. What I would think about is where we're at today. Why? Well, the good part is corporate fundamentals, earnings, profit margins, investment, and then you're also seeing from an economic side, fiscal and monetary policy are going in a more tailwind direction. Those are all positive things. Naturally, on the other side, you need to keep an eye, though, on some of these themes breaking down. Inflation at a time when You're seeing cuts in the Fed conversation. And then some of these other areas that, opportunities, but also, like I said, AI spending and things like that, that we're certainly trying to make sure that we're getting ahead of, that we're focusing on, the labor market, where that goes. But a lot of these conversations are all happening. They're all part of the decision-making process. And I have rambled for a while here. So Christian, I think it's time for a question to whatever that came up.
Well, this is one of the benefits of hosting the investment webinars. I get to ask the first questions because I have some serious thoughts as I listen to you. If we've got such strong fundamentals, such strong margins, we're seeing all these highs. What's the disconnect between what's seemingly a fundamentally strong economy and this consumer sentiment? That we're having the lows. Are there risks that aren't priced into the market? Is it a political media driven thing? What's your take on that?
Yeah, it's a good question because it's nuanced, and that these sentiment surveys, they help you understand where people's mentality is. But the reality is, like, how they're done is like they're calling people, and at any given time, somebody can be feeling whatever they're feeling. So it can be good, bad, and different. I think one of the things that we've seen is that when you look at a lot of the conditions and the sentiment by income quadrant, right? If you break it down by, quartiles, or even just go more granular at the decile level, what you see are the highest income earners are feeling great. They're spending a lot of money. The lower, especially the lower half, really even you go further down, the lower, 10, 20, 30% income earners, they're feeling squeezed, right? They're feeling a housing market that's overly expensive, higher rates. They're feeling, their income probably not keeping up with inflation. They're probably having to trade down in terms of where they're spending their money. And I think that's where some of the disconnect comes in, is where some of these things happen. And look, at the end of the day, the challenge is, when you look at that, you have to reconcile where, okay, well, what is driving the economy? Who are the consumers that are spending to drive it? Is there potentially, the opportunity for that sentiment to expand beyond, call it the bottom 2, 3, 4 deciles of income, and move up the chain if things get more expensive or things start to break down? I think that's a lot of it. And then Christian, the other part of the good question is, like, the labor market is weakening, and I think there's a lot of uncertainty there, a lot of concern there. What happens with AI, for as good as it is from a productivity standpoint, potentially cost-cutting standpoint, what does it mean for labor? What kind of jobs will be displaced? What kind of jobs will just cease to exist? And how does that work? And that there's so much uncertainty there that, we're not quite sure.
And in regards to AI, with these, you and I have talked about this, crazy P/E ratios, all-time highs, the very narrow market, even just a few companies doing this. When does that become a scary situation? I mean, we certainly don't want to miss the boat on trends that are profitable and could be forever long lasting. So when does it become an issue where we say this has gotten too out of control?
Yeah. I heard somebody mention it on a video the other day, and I thought it was really, succinct and well said, that all eyes, I believe it's November 19th. I believe it's November 19th. That is the next day of NVIDIA earnings. And the reality is the market will move on what goes on with NVIDIA earnings. And so much of it is driven on the demand for that space, which impacts so many of the companies that have grown. As expensive as someone like NVIDIA is, if you look at their growth rates, you should be more than comfortable spending that, most likely, right? It's not a recommendation to go buy it, but like understanding why, even with how expensive the company is, as long as those growth rates are there, we're comfortable. Like we understand why. If earnings growth, top line revenue growth, if those start to plateau or start to come in, paying these types of valuations in that type of environment does not make sense. So to us, especially when we're looking at valuations, the hard part is, yeah, if you look at, the next 12-month PE on NVIDIA, it looks expensive relative to the market. Not crazy, but it's expensive. And then what you have to do, though, is extrapolate, okay, well, what's priced in there from a growth standpoint, and can that sustain itself? And what happens if that growth trajectory starts to break? And that's the stuff we're looking at, because I think that is what can fundamentally start to change what's happening there.
All right, I've got one more. So 2000s, 2010s, all international, right? Just it killed it. It was the thing to be in. Large cap domestic makes this surging comeback. So really 2015 forward, and there's been international hawks out there screaming, hey, we're coming back since 2015. Never happening. Finally, we have this year that so many people have predicted was coming for the last decade. Why this year? Why now did international?
It's like the old economist saying, right? The economists have predicted, 11 of the last 4 recessions. Look, it's 100% true that international performed well this year, and it should open some eyes. Now, from my perspective, not a whole lot's changed because we have continued to own international in a lot of our portfolios for some time. And it's not to make a bet. It's just one is the diversification conversation. But the question we get, and I think this is a really good one, is what would make us increase that international weighting? Why, because if you think about the global market, it used to be 55% US, then it was 60. Now it's close to 70% US. It is driven so heavily towards the US. There's a couple things. Part of the reason why international has performed so well this year has been the US dollar's depreciated, which is something we look at because as the US dollar depreciates, if you look back to the mid 2000s, right, the 2002 to 2007, 8 time period, US dollar continued to depreciate. That is a tailwind for US investors owning international assets. Valuations. So the good part is international has been cheaper. Now it's been cheaper for a reason. It's been cheaper because the growth rates have not been very good. So, you pay for what you get, and, a big bank located in Germany just hasn't been growing in the same way that a JP Morgan has. So when we think about adding, what needs to happen? We're not going to make that decision entirely driven on those technicals of a weakening dollar and valuations, right? They will be a piece, though. We're not going to ignore it, right? As the dollar continues to weaken, even where it's at today, it makes us more comfortable owning international. Valuations, if they're cheaper, we like that, especially if the US starts to get a little bit even more expensive and we're concerned about the growth rates. But that last piece there, the growth needs to be there. We need to see earnings growth creep up either internationally or come down in the US, because anytime you add to one area, that means you have to source the capital from another area, which likely means we're taking it from the US. And if the US growth rates are just more attractive, they're continuing to grow, and either developed or EM aren't growing where you want them, or they just have plateaued, it just doesn't make us overly excited to jump in an area. It feels like we're more running from something than going towards something at that point. And I think there's got to be other factors that make us want to do that, especially with a weakening US. We just don't see that at this point. So to us, we look at the international markets as more complementary to what we're doing here in the US. We will continue to own them. We think there's diversification. We think there's a lot of good businesses, right? You think about the NVIDIA story. Well, guess what? There's other stories like TSMC, who, is a foundry for most of NVIDIA's chips, right? The Samsungs of the world, the ASMLs. There are a lot of good businesses internationally that many people know. But we just see the growth rates here in the US. We would want to see that start to flip a little bit internationally to get more excited.
Excellent. I think great information as always. Mike, you've done a great job. We really appreciate everyone's time today. If you have any questions and want to reach out, I think that most of our attendees know how to do that. But we hope that everyone has a great rest of your day. And thank you again, Mike.